Hello, everybody, and welcome to our webinar on listed private credit. I would like to give you a quick update of what happened over the recent months and what we expect, especially for the next year, also given the current yield environment and the current developments that we have seen, especially in the US, on the interest rate environment. When we look at private credit, we can certainly say that in the meantime, this has been an established asset class. Also, when we look at the listed private credit environment, we see that we have roughly 45 companies listed on the stock exchange and that provide private credit capital. In total, the combined market cap is around 50 billion. So it's still a niche market, but a very attractive niche market, providing access to private credit without any restrictions, without any limitations, and with daily liquidity and no minimum investments. When we look at the current yield level, it's very interesting, especially when we compare the yield of listed private credit to a high yield index or to a leveraged loan index. We currently see a yield level of more than 11% based on the current price environment that we see for listed private credit companies and based on the historical dividend payments from the last quarters. And here the assumption is that the past dividend payments continue for the next quarters to come. But as we see in the next slides, we have seen also a decrease in the stock prices of private credit companies. And the main reason for that is that the SOFR also decreased. As you probably know, when a private credit company gives out a loan, the interest rate payments are linked to the SOFR index plus a premium on that. But that means when the SOFR index decreases, this means also lower income for the private credit companies. And this is reflected in the current drop of the share prices of those companies. But it's good to know that it's not related to any problems in the underlying credits or loans that have been provided to medium-sized companies. It's mainly based on this decreasing SOFR index. And when we have a look at our indices, and before we do that, I give you a quick intro of how we construct the index. So we start with listed private credit companies, so companies that are provided on the stock exchange and provide credit loans to medium-sized companies. And we cover around 5,000 single loans in combined overall listed private credit companies. We do then a liquidity analysis and then take the 25 largest companies to be included in the private credit index. To give you a quick overview of how this developed over the past years, this is the chart over the past 15 years in US dollars. And you see here two lines. The dark blue line is the private credit index, including dividend payments. And the other line is the private credit index, excluding dividend payments. And as you can see here, the main performance drivers are dividend payments. So if you exclude the dividends, you basically make no return. And this again shows that the underlying loans and interest rate payments are the main driver for the performance in this private credit index. And when we look at the dividend payments, they are paid out on a quarterly basis. And here the assumption is that this is reinvested into the index, and this gives then the performance of the dark blue line here. And again, performance drivers are dividend payments, and dividend payments are fueled by interest rate payments from the loan receiving companies in the portfolio. So this is important to know. And again, the current drop that we see in the current year, that is around 8 to 10% in US dollars, is driven by the fact that the SOFR rate declines, and this would mean that interest rate payments will slightly decrease in the current years to come. Nevertheless, when we look at the yield, we've seen that the yield increases based on the current dividend payments that we see in the portfolio. Let's have a quick look on the underlying characteristics of the credit portfolio. Here you see a look through the loan portfolio. You see that most of the loans are floating rate loans. Almost or more than 90% are based on floating rates. That means that what I described at the beginning, when the SOFR, which is usually the interest rate or the defined interest rate, that when this decreases or when this increases, this also changes the payment structure, because you always have the SOFR as a basis and then a fixed addition to this interest rate. And as you can see, more than 90% is floating rates. Almost 90% are secured loans, around 12% are unsecured loans, and most of the loans are in North America, and all of them are dominated or denominated in US dollars. Now let's have a quick look at the industry sectors. It is a very diversified portfolio across various sectors, financials, information technology, consumer discretionary, industrials, and so on. So you have a full or a very diversified portfolio of loans in the investment portfolio. And the combined credit volume is more than 150 billion US dollars, and we have nearly 5,000 borrowers in the portfolio. Here you see the historical dividend yields. It was always between 7 and 10%. As mentioned at the beginning, the current yield based on the historical dividend payments and based on the current stock price is more than 11%. So it shows a very attractive entry point. Of course, this depends on how the market develops in the coming months and quarters. But given the current development, we are quite optimistic. Another interesting point, and this is, I think, very a question that we get a lot in the current environment. How can you measure the credit quality of the loan portfolio? There are several possibilities to measure that. One is the so-called payment in kind number. That means that we check whether interest rate payments have been made in cash or not, because the companies have the option to not pay the interest rate payment in cash, but we rather have it as an additional liability. So changing payment in kind numbers can be an indicator of stress in the loan portfolio. Another indicator can be the so-called non-accrual loans. So those are loans where the interest rate payments have been stopped. And this can be calculated in two ways. Either related to the fair value of the loan or related to the cost value, but I come to that later. Here we see the payment in kind development over the past years. We currently are at a slightly elevated level compared to 23 or 24, but the numbers came down compared to end of last year. We are currently updating the numbers also for the third quarter of 25, and we expect that those numbers come out in the next weeks. What we have already collected and was already also announced from most of the companies, not for all of them, but for 19 out of the 25 companies. We have in the meantime the non-accrual rates for the third quarter of 25. And as you can see here, there is no significant change. And especially we don't see any sharp increase in those numbers as of today. As mentioned, 6 companies still have to publish their numbers, but they will also come out in the next weeks. So by end of the month, we have a full picture here. But what we can already say at this point of time is that we don't see any increased level in the non-accrual rate, which I think is a good sign given the current news and the market sentiment and the noise that we see in the market. So it's rather a bad noise that we see in the market, but it's not driven by any facts because we currently don't see any stress in the portfolio, which is at a higher level than last year or in 23. This is also reflected by the so-called premium discount index. We currently observe a discount of around 6% in the market. This is as of October, end of October. So again, this shows that there is some noise, some bad sentiment in the market reflected by this discount, because typically private credit companies also tend to trade at a premium, especially in 2020, 21, 22 also, and 23 and 24 we see that those companies trade at a premium. But currently we see those companies trading at a slight discount, and some companies trade also at higher discount. And here the question is, how can you again analyze the credit quality of those companies? And we do that by analyzing mainly the payment in kind numbers and the non-accrual rates also on a single company level. So summarizing, we currently saw a drop in the stock prices of private credit companies in 25, which is around 8 to 10% in US dollars. This is mainly driven by the fact that it is expected that the interest rates in the US especially will go down further. However, part of that is already reflected in the current price. And my impression is that more is reflected in the current share prices of those private credit companies than probably might occur in the coming months. But this is to be seen. We don't see elevated payment in kind numbers. We don't see elevated non-accrual rates. We see a discount in the market, which is not at a very high level, but it's still, I would say, at a level that is or that could be a very interesting entry point. But it really depends on the fact how the interest rate environment continues in the coming quarters, especially in the United States. So that's it from my side as a quick update on private credit. As always, if you have any questions, feel free to reach out to me or to one of my colleagues at LPX. And otherwise, I look forward to our next webinar. Thank you very much.